The real estate industry is an ever-booming market, with the market shifting between the seller and buyer at per time, coupled with the influence of the interest rate and inflations. Yet, this industry has a great potential in creating a generational wealth for anyone who desires to learn and join the wealth financial vehicle called real estate investors. Prior to delving into the strategies, it is imperative to first expound upon the definition of the term generational wealth. Generational wealth pertains to assets and financial resources that are bequeathed from one generation to the succeeding one. This concept is distinct from that of financial freedom, which pertains to the immediate enjoyment of life. In contrast, generational wealth encompasses a legacy that may comprise of tangible assets, a business, real estate, investments, and other income-generating instruments that can be passed down to future generations. For disclaimer, this video is just for education purposes. It is not meant to serve as professional financial advice. Remember, we trust you will support this channel by simply click the subscribe button and hit the notification icon. This will help us to grow and improve on the quality of what this channel offers for our esteemed viewers. As high net worth individuals contemplate their estate plans, the paramount concern is the establishment of generational wealth. Investing in real estate presents itself as a highly effective means of achieving portfolio diversification and cultivating wealth that can be bequeathed to younger family members, all while maintaining a certain level of flexibility. Real estate, as an asset class, possesses distinctive attributes and strategies that can serve multiple purposes for an investor. This asset class inherently exhibits lower volatility and a diminished correlation to stocks and bonds, thereby enhancing the risk-return profile of a portfolio. Real estate investments can prove instrumental in assisting high net worth families in investing in a real estate syndication is considered to be one of the most effective methods for families to establish enduring wealth. Real estate syndications involve the pooling of resources from multiple investors to acquire commercial or multifamily properties, typically apartments. The project lead, also known as the general partner, assumes responsibility for all operational aspects, while the investors, referred to as limited partners, contribute the necessary funds. Although all investments carry inherent risks, syndications have gained popularity due to their potential for generating substantial returns within a relatively short period. For instance, a syndication may offer an 8% annual return over a 5-year term, coupled with a 50% increase in the initial capital investment upon completion. In this hypothetical scenario, the investment in the syndication would nearly double its value within 5 years. The general partner utilizes the pooled capital to undertake renovations and improvements on the properties, thereby enhancing their rental potential. As the value of commercial properties is closely tied to rental prices, these enhancements result in increased worth. After approximately 5 years, most syndications aim to exit the investment, selling the newly renovated building at a significant profit. The limited partners then receive a portion of the rental income and a share of the proceeds from the building's sale. Investing in multifamily properties does not necessarily require a syndication. Depending on your financial capabilities, you have the option to invest in multifamily properties independently. Technically, any building with more than 4 units qualifies as multifamily, making it possible to find reasonably priced properties that meet this criteria. There are numerous advantages to investing in multifamily homes compared to single-family properties. The most significant advantage is the cash flow. Single-tenant properties pose a higher risk of cash flow loss, as vacancy can halt all cash flow if the tenant leaves. In contrast, multifamily properties have a lower risk of this occurrence due to the presence of multiple tenants, ensuring a more consistent cash flow. When tenants leave, others remain, and new tenants can be acquired. While single-family homes are a viable investment, multifamily properties offer greater potential for building generational wealth. Owning a few multifamily apartment buildings can provide you and future generations with a reliable source of passive income. Investing in real estate investment trusts, REITs, is another option to consider. REITs are companies that own and often manage income-generating real estate. These entities can be publicly traded on well-known exchanges. When investing in a REIT, you are purchasing shares in a company that owns the underlying assets, rather than directly owning the real estate. Returns on REITs typically differ from investing in syndications. Syndications factor in cash flow and property sales, resulting in potentially higher returns. On the other hand, REITs align more closely with typical stock market returns since they are publicly traded. Nonetheless, REITs offer an excellent opportunity to diversify your real estate portfolio rapidly, particularly as your wealth grows. The BRRRR method, an acronym for Buy, Rehab, Rent, Refinance, Repeat, is a strategic approach that enables individuals to acquire distressed real estate, lease it out, and utilize the accrued equity to finance subsequent investments. A typical implementation of the BRRRR method entails identifying a dilapidated property with superficial damages that can be rectified relatively easily, preferably through personal efforts for enhanced cost-effectiveness, yet adversely impact its market value. For instance, an individual employing the BRRRR method may come across a residence with outdated paint colors, antiquated cabinets, and obsolete appliances. Although these issues can be readily addressed, they may impede a successful sale, consequently leading to a diminished selling price. Upon procuring the property, the next step involves renovating it and subsequently leasing it out. Once a suitable tenant is secured, the property can be refinanced, and the obtained funds can be utilized as a down payment for the acquisition of another property, thereby initiating a repetitive cycle. The accumulation of generational wealth through real estate is a more feasible endeavor than commonly perceived. By employing real estate tactics such as investing in real estate investment trusts, REITs, or participating in multifamily syndications, as well as utilizing the Buy, Rehab, Rent, Refinance, Repeat, BRRRR method and engaging in house hacking, individuals can effectively establish a foundation for generational wealth. It is important to note that the information presented in this context does not constitute investment, tax, or financial advice. It is highly recommended that individuals seek guidance from a licensed professional who can provide tailored advice based on their specific circumstances. In this video, we are also recommending 6 crucial ways on how to leverage real estate investment strategies to foster the growth of generational wealth. Number 1. Offset low interest rates. Due to the current historically low interest rates, there exists an insatiable demand for higher yields. Consequently, clients are unable to generate substantial income from their conventional fixed income investments. Real estate, with its cash flow nature and the potential for stable occupancy through long-term leases, offers clients the opportunity to attain stability and complement other aspects of their investment portfolios. The choice of the appropriate investment vehicle depends on the client's risk tolerance and investment objectives. While some investors with an active approach may prefer direct ownership of property, there are also passive alternatives such as private real estate funds and traded or non-traded real estate investment trusts, REITs. These options provide similar benefits for individuals who do not wish to actively manage physical properties. Over the past 2 decades, private real estate has consistently delivered a level of income with an average annual cash return of 4%, thereby offering an appealing prospect for a specific type of client. Number 2. Hedge against inflation. With inflation expected to rise in the United States, investors are seeking strategies to offset that risk in their portfolio. Historically, REITs have performed better than the broader equity market during periods of moderate or high inflation, making them an effective hedge. The conversation has changed from a year ago, Barker says, because while interest rates were low then, and remain low, the fear of inflation is a new factor. Due to the embedded characteristics of the asset class, rents typically rise in line with inflation measures. Real estate income during the last 25 years has increased at a slightly higher level than inflation. This differs from fixed income investments that are tied to interest rates and don't offer the same inflationary protection. Number 3. You need to adjust your exposure. Investors who are new to real estate opportunities do not necessarily need to make significant adjustments to their portfolio in order to benefit from this sector. According to Barker, growth investing will continue to be relevant as long as interest rates remain low. However, for many of our clients with higher net worth, it would be appropriate to allocate approximately 5-7% of their portfolio to real estate, including both liquid REITs and illiquid real estate investments. Real estate possesses significant potential for appreciation, making it an ideal asset to transfer to younger family members. This transfer would effectively remove any potential future appreciation from the owner's estate, thereby reducing the impact of federal estate taxes. Number 4. Considering gifting strategies. Real estate is a versatile option for gifting, as it allows for appreciation and provides the current owner with liquidity during their lifetime, according to Doyle. For instance, a vacation home can serve as a meaningful gift that holds sentimental and financial value for future generations. Additionally, investing directly in other types of property can facilitate wealth growth and transfer, while avoiding complications related to estate taxes. Doyle explains that gift tax valuation discounts can be obtained by giving fractional interests in real estate. By assigning lower valuations to minority interests in the assets, the estate owner can secure future tax savings. Furthermore, these valuation discounts are also applicable to the original owner who retains only a minority interest in the real estate. However, it is important to note that navigating real estate within an estate plan can be complex, and seeking the guidance of an estate planning strategist can be beneficial in ensuring a tax-efficient transfer of real estate. Number 5. Invest in emerging opportunities you may find. In recent times, the pandemic has brought about significant transformations in various property sectors, thereby creating investment prospects. The surge in e-commerce has presented both challenges and opportunities for specific types of real estate properties. While traditional brick-and-mortar stores have faced difficulties, there has been an increased demand for properties associated with warehousing, supply chain management, and logistics. This demand is expected to remain strong in the foreseeable future. Bianchon highlights the COVID-19 vaccine as an example of how emerging societal needs can generate real estate opportunities. He emphasizes the examination of how the acceleration of business models impacts the real estate sector and how our clients can potentially benefit from these changes. When transferring ownership interest to future generations and beyond, real estate can serve as an ideal asset. It essentially allows for the transfer of a growth asset at a discounted value. Number 6. Leveraging capital gains. According to Barker, a viable approach for affluent families to safeguard capital gains is to allocate funds towards opportunity zones and opportunity zone funds. These zones are designated as economically distressed communities where fresh investments are eligible for tax benefits, including the deferral of capital gains tax. This investment vehicle also serves a dual purpose by providing real estate investment exposure to a client's portfolio. Clients have a considerable amount of unrealized capital gains, and this is an opportunity to realize gains, make portfolio changes, defer tax on realized capital gains, and invest in real estate through the Opportunity Zone Fund. The potential for higher tax rates, coupled with the significant tax benefits provided within opportunity zones, where investments in property types such as multifamily and affordable housing will be prevalent, presents a compelling opportunity for clients to engage in a targeted real estate strategy that can also do good. Thanks for watching.